Good evening, friends, and it's a pleasure to be coming back and talking about 29th Wealth Creation Study. So this is started in 96 when the company became corporate. So to felicitate the corporatization of the company, we came out with this study, and since then we have been keeping the tradition on, and this is 29th year. In fact, to me also it's amazing that if a non-stop 29 years. So this has been a fantastic journey, and now it is a way for me to learn in the stock market. So this study particularly is a framework. It's a how to think about particular type of companies, and it is the biggest education to me, as well as I'm sure it is a way of think with a lot of people, those particularly in this kind of growth mania market, they don't look at. I mean, it just gets blindsided. But the big opportunities are thrown there, and very serious amount of wealth has been created by the practitioners of this particular strategy, and it will come out in, I think, panel discussion even more clearly, because I am not a practitioner of this strategy, but there will be panelists like Amit Goyala and all, those who practice this, Rakesh Jhunjhunwala and all, he will be able to talk a lot more about this particular strategy. So this we call it creating wealth through bruised blue chips. The three parts of the presentation. First is wealth creation finding. In last 5 years, what has happened, how the market has, what are the winners, losers, and the pace of wealth creation, pace of wealth destruction. And then second is the thematic, bruised blue chips. And third is the current market outlook, which would be of interest to everybody. So let's start with the study findings. So concept of wealth creation, for the people who are coming for the first time, the process by which a company enhances market value of the capital entrusted to it by its shareholders. So this is the biggest game in town. Worldwide, I think all the corporates, in fact, all the wealthy guys all over the world, they are made up of the market caps. And it is about $120 trillion game, US being 62 and a half, $63 trillion. So, but this wealth has been created by some amount of money given by people to the managements, and they have enhanced the value. So clearly, this is the biggest game in town, and hence it is worthwhile to study how this wealth has been created by people at large. Net wealth created in last 5 years is calculated taking the 5 years gap in the market cap of top 100 companies and adjusted for the whatever corporate actions the companies have done in terms of raising money or equity dilutions. These 100 companies, top 100 companies we have picked up, they have created wealth at the rate of 26% compounded for the last 5 years, whereas the market has done about 14%. So clearly, if you see all the past studies, every time this set of 100 companies, they create at least 10 to 12% higher wealth than the market itself. And this gives that extra opportunity for the active managers to create wealth for the shareholders through mutual funds or by practicing individual stocks also you can buy. If you see the last previous studies, you'll find that the Sensex has a earnings growth. Last column, if you see, the Sensex has an earnings growth compounding of 14%, and it has created. The Sensex has grown at 14%. The earnings have grown at 16%. The wealth-based company, WealthX, have grown at 25%, and the earnings have also grown at 25%. So G is equal to R. Always you'll find that growth rate is equivalent to the amount of money you make in the market. Time and again, if you look at 5 years, 10 years, a lot of group of companies, typically you'll find that if you find a decent company, the rate of return is equivalent to rate of growth. So Nestle might be a very good company, most brilliant company in the world at 100%, 80% ROE, but if it doesn't grow, if it grows at 15%, it can, most likely the stock will go up by 15%. So clearly, this is what happens with a group of companies. The amount of wealth created in last 5 years is 138 lakh crores by top 100 companies. Now, top 100 companies are the companies which have, by market cap, these companies, they have beaten the pace of wealth creation has been higher than that of pace of Nifty rise. So some of the large companies like HDFC Bank have been deleted. I mean, they have not made it to the list, but these are the top 100 companies which have beaten the markets in last 5 years. So these 100 companies, they have created 138 lakh crores of wealth. You just see in 2001 and 6, it was just about 14 lakh crores. And steadily this has been climbing. And in 22, it was about 92 lakhs. And now it is 138 lakhs. So the size of wealth being created now, it is for the first time, now maybe second time, it is $1.5 trillion of wealth has been created by just 100 companies. So total wealth by all the 4,000 companies, it could be closer to $2.5 trillion. So now we are into serious wealth creation in economy in last 5 years. Now the next thing is, which is very strange, and this is a chart I would request to little focus on, that is the wealth destroyed. Typically what happens is, the amount of, you have made in 100, 200 companies, you have made, say, 138 lakh crores, but the amount of money destroyed by few companies like Vodafone, Bandhan Bank, Yes Bank, all these add up to just about 4 lakh crores, which is 3% of the total wealth created. So if 138 is created, only 4 lakhs is destroyed, which is very unnatural. It should not happen like that. There has to be 15 to 17%. That's a natural thing. I mean, if you come to the market and you can't lose money, then the whole world will come here only, because downside is 0, upside is 15, 20%. So that's the kind of situation we have reached, where there is no loss of capital in this market, or barely close to 0, and upside is like 15, 20, 30% depending on your pick. So if you see, in 2006, it reached to 1%. When that boom was there, 2003 to 6, that time we reached to 1%. Then 6 and 7 and 8, 2 more years it perpetuated, and then it collapsed. So this is the first year, this is the first year when we are observing 3% wealth destruction. I don't know how long it will continue, but it is a clearly danger sign that market is heated, and be careful. For what reason it will go down, I don't know. Whether it will be global, local, or combination of global, local, something is going to happen whereby maybe after a year or two, God knows, maybe after 3 years of bull run, but it is setting the stage, because you have reached to a stage where you cannot lose money in this Indian market. So this is a very strange situation to be, but that's what it is. You cannot lose money in the market at this juncture. So the study has 4 categories: largest wealth creators, fastest wealth creators, most consistent wealth creators, and all-round wealth creators. So here you have the most coveted wealth creators: Reliance Industries, 11 lakh crores in last 5 years at the rate of 20%. TCS, 8 lakh crores. Bharti Airtel, 5.5 crores, 5.5 lakh crores. So none of these top 10 are less than 3 lakh crores. So there's serious amount of money which has been made, even by the large caps, which have not done so well in terms of index movement in last 5 years. And so this is and the pace is also pretty good. So it's not that elephants can't dance. So we should not feel that only mid and small can make money and large caps cannot make money. My sense is that very reasonable pricing is there of large caps, though it is very unpopular, and it is very counterintuitive to say that large caps will make money, but seeing the situation, and when we go deeper into the study, you realize that probably the place to hide is large caps. Fastest is all kinds of companies: Adani Green, Adani Enterprises, and then Jindal Stainless Steel. So they have grown at literally 70, 80, 100% compounded in last 5 years. And the 6 companies out of 10 were about 6,000 crores. So if you really want very fast growing 70, 80% kind of growth companies, you have to buy the companies which are about $1 billion today. I mean, those companies which are 1 lakh crore, 1 lakh, 2 lakh crore, 2.5 lakh crore, they might be growing at 70, 80%, but they cannot deliver you what they delivered in last 5 years. We have to be very careful about that. And but then this portfolio, if you get one right, I think it can change the character of the portfolio. So the total return of this top 10 companies about 77% compounded. And another thing I saw is that 5 out of 10 companies have P multiple more than 100 times. See, earlier 100 P was like a rarest of the rare phenomena. But look at the last but one column. Of the 10 companies, 5 companies are more than 100 P multiple. And we look at like as if it is a normal phenomenon. You know, this 100p has become crazy. So, and from here also they look to be, I mean, at least the managements want to be scaling to higher levels. And most consistent wealth creators are, they look a little more sensible, and only 6 companies have performed 5 out of 5 years, and there are 4 companies which have done 4 out of 5 years. The all-round wealth creating companies with the biggest, fastest and consistent is Adani Enterprises, Adani Green, Hindustan Aeronautics. So these companies have beaten all the categories and come up to the all-round wealth creators. These are companies which should be seriously looked into what is really in them that they are fastest, largest and most consistent. The industries which have done well, financials have done the biggest. I mean, they have contributed 16% despite the underperformance of private sector banks. The public sector banks have taken the nudge at this time, and they have really come up big time, 8 times, 10 times in last 5 years. Technology has been second. So these 2 categories, they remain very big, and they have not done so well in last 5 years. Despite that, they are the largest. So the future still hangs on them. But I think utilities, which were the kind of nobody bothered about them, that has come back. I think a lot of Adani companies are in the utilities, so that has contributed big time. Then another one which has done well is the capital goods. The capital goods have contributed, I mean, 4th largest is capital goods. I think one fundamental thing which has changed in Indian structure of growth, which we were looking at yesterday, is that one, the PSU banks which were sick and down, they have come back, and SBI, which was literally at one point of time, they incurred for 1 year, they incurred loss. Last year, I think they made about 67,000 crores of profit. Current year, they're expected to make 80,000 crores of profit, and maybe next year it might be closer to 1 lakh crore profit. So that's one PSU bank's profitability comeback is immense. Second, I think somewhere the consumption has taken a back seat, and the earnings are driven by capital goods companies like Hindustan Aeronautics or Bell and L&T and whole lot of them. So the earnings growth which has started from, we'll talk about it, but earnings growth has started taking off from 2019, from 2020 post-COVID. And there one fundamental change happened. Government went from 3% fiscal deficit to 6% fiscal deficit, and the whole thing went into the capex, government capex. And that changed everything. So consumer consumption remained stagnant, and the capital goods started growing, and that led to, I think, the earnings growth revival of 18 to 20% for last 5 years, and we'll see it in the charts going forward. I think this is the most dramatic graph, and it comes only in the wealth creation study, where the PSU, which were about 40–50% of the market, wealth creation in 2004-05, methodically kept on going down till about 2020. In 2022, it became 0. There was no wealth creation by any of the PSUs. And then from there, it has become 17%. 20 companies have contributed 17% of the wealth creation. And look at the data on the left, on the right, where still the earnings growth of PSUs, earnings growth of PSU, PAT growth is 29%, and private sector is 20%. And the current P multiple of private sector is 33, whereas public sector is 12, which includes Coal India, BP, HP, IOC, all sorts of large monoliths. But they're at 12 P multiple, and private sector is 33. You can decide for yourself. My sense is there is still a lot of steam left in this so-called unpopular PSU category. In terms of valuations, for the first time, turnaround companies. I mean, I think this is a study about the turnarounds, and somehow the data also says that in last 5 years, 14 companies have contributed 14% of wealth created, and they have grown at fastest rate of 46%. So now there is a new category, not low P, no low price to book, but turnaround companies. So they are large turnaround companies. They have done extremely well. I'm literally growing in every 2 years. That's the kind of the finding that even the loss-making turnaround companies, they can create magic in the marketplace. And this is a repeat of that. Price to sales below 1 is the place to look at. I mean, these are all rare numbers, getting companies at price to sales below 1 is unheard of today, but that's the number which actually creates wealth. Payback ratio, next 5 years profit divided by current market cap, even that does well. Same is the PEG ratio, that has also done very well. So growth has been rewarded amply in the marketplace. Now, coming back to the real second part of the study, so that was about what happened in the market in last 5 years. The theme, bruised blue chips. Now, so what is the bruised blue chip and how does it come into picture? So one of the things is that conventional thinking is about buying robust companies, robust blue chips into your portfolio, so that year after year it keeps creating their wealth. But we realize that even the blue chips, they also have rough times. You know, they are not in a straight line. It just don't keep going up like bonds. They have a rough time, and when they are going through a rough time, that they get bruised. They don't lose the blue chip status, but they definitely get bruised. And best of the companies have been bruised for various reasons, for external, internal markets, out of the market, inside the market, but they do get bruised. And that gives you a fantastic opportunity to buy into them because they remain blue chips. Buying into troubled companies, potential turnarounds, is a contrarian approach. So from where we got this idea? So we wanted, when we started the study, Srinath, who writes this study, he told me that this year let's do turnarounds. We ran the data on the turnarounds, but we found that we are not going anywhere, in the sense that we are not getting any, we are not getting anything worthwhile because everything looked to be very average. Then we said, we read the book again. We found a book making money out of turnarounds, Bruised or somebody. And this guy wrote a 30-page book, and there he said, if you look at the turnaround companies, the companies, fallen angels or companies which have gone out of, fallen more than 50% from their all-time high, look at the companies which are bruised blue chips, or second bucket is busted growth stocks. So we said, this busted growth looks to be a little crazy. Let's focus on the bruised blue chips. And that's how we picked up this particular theory, and then we worked upon it, and we found that study to be very interesting. I mean, this can be executed. In fact, I was always scared, and always I thought, my guru said that turnaround seldom turn around. So let's not bother about it. And that's how I was thinking. But yes, if you start with the blue chips, I think you have a good chance of making serious amount of money without, and with a very high probability that you will make money. So let's do the study. So first thing is, everybody talks about blue chip, but nobody defined the blue chip. What is the blue chip? I mean, blue chip is in everybody's mind, it's a different thing. So how do you decide the blue chips? So we said, let's look at the companies which are the highest ROE in last 10 years. So return on equity is the best way to figure out the quality of the machine. So we said, let's look at the companies with above 15% ROE, which is also a very stringent norm. Then we found that our top 250 companies, we found about 150 or 147 companies to blue. I said, it cannot be that more than 50% companies are blue chips. So then we raised the bar to 20%, and there we found that we have got about 107 companies, including the top 50 Nifty companies. So Nifty companies came because we can't say Reliance is, say, 14% ROE. So we can't say that Reliance is not a blue chip. So we said they are the leaders, they have the massive investments happening. So for some reason their ROE is low. So we said any company which is in Nifty, that also is called blue chips. So companies in Nifty to be blue chips, and companies with 20%, 10 years ROE are also blue chips. Like that, we got about 107 companies. And that's what we have decided as a blue chip and for the studies. Now, bruised blue chips. What is the bruised blue chips? So this, if I'm talking about 20%, it doesn't mean that 19% earning is not a blue chip. It is also a blue chip. But for the study, we have to give a cutoff somewhere. And that's where we decided to cut off at 20%. So, I mean, everybody can have their own notion of, I'm doing with ROE, somebody can do it with ROC, somebody can do with EV to EBITDA. So that's their call. But you have to look at the consistent performance for last 10 years. So that's the blue chip study, blue chip category. Second is bruised blue chips. So we said, borrowing from the book, bruised blue chips are the companies which has lost at least 50% from last 5 years high. So in last 5 years or maybe all-time high, if a company has lost, it was 1,000 rupees and it has fallen below 500, then you can call it a seriously bruised company, and then you start doing your studies, which we'll talk about it a little later. So those are two definitions which we have clearly started, because these definitions are not there, to start with. So we have said, unless these definitions are there, we cannot move forward in the study. So why bruised blue chips? So you see the golden opportunity of making tons of money at a very rapid pace in a blue chip space. So these are the top performing those ideas, bruised blue chips. So look at the third column, where the amount of price fall. The companies, the best of the companies, Cummins, Bank of Baroda, M&M, Glenmark, they all have fallen more than, on an average, 60% from their top. This is the level of fall you can see in last, whatever periods we have talked about, 2010 to 14, high price, and low priced 15 to 24. So first 5 years is a high period, and next 10 years is the observation period, where the companies fall to the low levels. So price has fallen by 60%, and return from the fallen level is upwards of 50% compounded. And some companies like Cummins have given 80% compounded. So you have to be lucky to find this kind of companies and then buy a lot of them. That we'll talk about it, the position sizing, but this is what the return can be. And look at what happens to the valuations. The companies on average from 23 PE goes down to 8 P multiple. It goes down from 5.5 book to 0.8 book. These things have happened. We think in this market these are not possible. Ye sab hoga wapas. This is going to repeat for sure. And we'll see, what is happening in some of the examples we have given. So we looked at all these companies in last 7 periods of 5 years rolling. And if you focus on the last column, there are 78 average companies every year. Blue chips. Out of that 250 companies. Of that, 40 are bruised and 38 are not bruised. So 40 companies every year, they get bruised. More than 50% from that high, it goes down. Then what happens? The bruised blue chips, they fall by 75% on an average. 75%. And non-bruised, they fall only 28%. Since they have fallen low, they also appreciate only 23%. Whereas the one which has fallen by 75%, they come back at the ferocious speed of 55% compounded. So there is a case for the bruised blue chips to be studied. It gives an asymmetric payoff. So just think about it. If the stock has fallen by 75%, you have come down from 100 to 25. When it goes back to 100, it is a 4x for you. And 4x happens in 2 or 3 years. So it could be 70%, 80% compounded return. When the stock has fallen by 50%, it gives a doubler. Even if it takes 3 years, it is a 25% return for you. And the beauty is, downside is very limited. In investing, if once your downside is taken care of, upside will take care of itself. Because you are buying at prices, and they are deepest of the blue chips. We'll talk about the names, which are, we are not talking about some run-of-the-mill unknown stocks. We're talking about large leader companies like Bharti Airtel or Mahindra & Mahindra. These are big names. Telco, Indian Hotels. These are companies which are deepest of the blue chips. But they have fallen by the wayside, and they have given these kind of returns. But most important is that there is literally zero chance of permanent loss of capital. See, it is an art. Let's not make it very simple, that just something has fallen by 70%, so let me go and buy and, you'll make money. No, it's not that simple. We'll come to that. But basically, you cannot lose money, but if you buy it well, I think you can be sitting on a multibagger. So what causes the blue chips to get bruised? There are basically 3 reasons. First, the stock market itself. The market can crash and everything can fall by 50-60%. We'll talk about that. Then company related, external to the company, internal to the company. And in most of the cases, all 3 come together. The company commits mistakes within, the company commits mistake outside, and the stock market also doesn't help. When all 3 come together, then you get 70-80% decline in the price. So let's talk about the stock market related bruising. 2000-2001, the Sensex went down by 56%. You imagine what would have happened to the stocks. In GFC, 61%. My portfolio went down by 67% in 2008. The 100 crore became 30 crores in 2000. And in 2008, my 550 crore portfolio became 225 crores. So these are real ones. Now at that point of time, nothing was spared. And if by chance companies are weak, people throw them completely out of the water. 2020, it was 38%. Very recently in 2020. In February, it was all-time high. In March, it became all-time low. But it was very swift. In 2 months, I think everything happened. So those were the opportunities where the master minds, when the framework is in your mind, you are able to sell something in your hand. Of course, that would have also fallen. But you can convert something has not fallen that much into what has fallen too much. So what is the external to the company? So this is the stock market related. Now we are coming to the company specific problems. So external to the company, like economic recession, sector slowdown, adverse change in competitive landscape. We are seeing in various industries, telecom, paints, all kinds of things are happening. Adverse changes in government regulation. Government suddenly comes, this is allowed, that is not allowed. You are seeing in many sectors, these regulators play havoc. Then value outflow, in value migration, when like public sector banks to private sector banks. And then global events. So we'll give example of all of them. So like sector slowdown, look at Siemens. Siemens profit came down in 2012 from 850 crores to 180 crores. Stock came down from 743 to 186, 75% decline. These are all real numbers. Adverse change in competitive landscape. Bharti Airtel, when Jio made an entry, I mean, this is actually thousands. So 6,000 crores profit came down to make 32,000 crore loss in 2020. 32,000 crores in 1 year. And then the stock tanked by 50%. Adverse change in government regulation. IOC, this flip-flop in the government fuel policy, the profit of this huge giant came down from 11,000 crores to as low as 4,000 crores. Stock tanked by 80% to about 31 bucks. PSU banks to private banks, PNB, from profit of 5,000 crores to loss of 10,000 crores. The stock came down by 80% from 279 to 50, 60 bucks just 2-3 years back. So, and global events, pandemic and all. Indian hotels came down from 350 crores profit to a loss of 250 crores. The stock came down from 156 to 60 rupees. You could buy Indian hotel at less than construction cost of the hotel. Forget about land and brand and everything. It was at a replacement cost of just the building. That was the kind of price at which you could buy Indian hotel, and this country could have not gone anywhere in the next 5 years without hotels. They had become COVID centers, all the Indian hotels were COVID centers. So, environment creates these opportunities. Then internal to the company, capital misallocation. This is the biggest source of problem in successful corporates. When the corporates are successful, tens of thousands of crores start flowing in, and then the management doesn't know what to do with the money. And in India particularly, they don't know how to distribute the money. And when they don't distribute, they end up putting up projects or diversifications which are not great. So capital misallocation, weak, outdated management strategy, whatever is successful, whatever has brought them here, they don't change and they don't rejuvenate the strategy to take it to the different levels. Third, poor corporate governance, just the sheer bad leadership, which they don't accept that this is a bad leadership. Fourth, debt pile up. They become, in terms of acquisition and all, they just pile up thousands of crores of, particularly in the overseas acquisitions and all. And then deterioration in financial performance. So we have all kinds of, all the examples are there in this thing book. Capital misallocation, Tata Steel, they spent $12-13 billion on acquiring Chorus. The stock went down from 92 to 19. 80% calculation. And you see lost 15 years performance. There is absolutely no, this brilliant company has lost its, charm because of foreign acquisition. Look at Hero MotoCorp, very big darling of mine, but they became the largest motorcycle company in the world, but they didn't change. They couldn't premiumize their portfolio. They couldn't make a success with their new products, and that led to profit decline, and the stock came down to as low as 2,400 or 1,500, sorry. So it was a 63% decline, but now they changed the management. And you see, again, it has gone back to 5,000. poor corporate governance. I mean, at CG Power, it's a classic case of actually literally bankruptcy, and Murugappa Group comes in, Velayan comes in, and they rejuvenate. The stock comes down by 96%. It has happened right in front of us, and just last 3-4 years. Debt pile-up. Jindal Steel, Suzlon, they went from 12,000-13,000 crores to 17,000 crores, 46,000 crores, and the fall in the stock prices are 60 to 91%. Then what causes the bruises to steal, I mean to heal, you know? Now how do you create a turnaround? So whatever is the cause of fall, it just reverses. So stock market related turnarounds have to happen with the markets coming back, which happens immediately after that. Second, company related, external to the company, that has to be corrected. Internal to the company, that also has to be corrected. So we have example for all of them. So all the sharp stock market falls, they lead to the sharpest possible recovery, and you get an opportunity of 2-3 months. In that window, if you buy, you're the guy who go to the bank. And the guys who just leave it scared, and actually you contribute to selling, you know, those guys, they lose the opportunity. And external to the company, economic recovery, sector tailwind. So and all these things can happen together, you know. So improvement in competitive landscape, favorable change in government regulation, all these things happen. So look at the Suzlon, which was completely out, and it had come to, I think the lowest is $2, 1.80 paisa or something like that. And so the stock fell, and then the tailwind started. The wind power became cheaper than the thermal power, and the world moved to the green energy, and this is where the sector tailwind came. I think market gave them 12,000-15,000 crores, and today it is more than a lakh crore company. I mean, what a classic turnaround it is. I mean, if there is one turnaround which is kind of, and I heard the story, the whole management was there at 8 rupees in this office, and we are still kind of waiting when to buy. So Suzlon, I think we bought some, but not enough, knowing our nature. When we hit the opportunity at 15, 16, I think it was possible. I think company also placed at 15 rupees, isn't it? And we refused to bite into it. But so it's a massive turnaround led by tailwind. Improvement competitive landscape. So Bharti, you know, the entry of Jio destroyed the profit pool. Whenever a big giant enters in any field, there is a destruction of the profitability, because other side doesn't allow them to enter very smoothly, and hence he has to disrupt the profitability of the industry for some time. And that is a period when the 4 quarter results come, they are very bad. So telecom went into loss, and the stocks became completely worthless. So much so that Vodafone is today a sick company. But the companies which survive, like Bharti, when Jio became from a challenger to an incumbent, they also want to make money. And now both are minting money. So now the stock has come from the 200-300 rupees to as high as 1500-1600 rupees. DLF, I think this is a favorable change in government regulation, that is RERA came in, and the market has also healed now. And here the stock was at less than 100 rupees for a very long time, very long time. And today it is at 800, 900, still it has not hit the all-time high. I think all-time high is about 1200 rupees. I bought at 400, sold at I think 600-700 last round. It went to 1200, still it is about 800-900. So there is so much of opportunity that, you know, it did come to me that at double-digit price, we must buy DLF. But somehow we didn't execute because we didn't have the framework. Now I have the framework. I hope I get yet another opportunity in the future. Internal to the company, all kinds of restructuring, change in management team and strategy, corporate restructuring, new product launches, cost control, debt reduction, recovering the finance. So whatever is required, whatever it takes to turn around, that has to be done. So M&M, I mean, we'll be discussing, Mr. Anish Shah will be here for the panel discussion. We'll hear the story right from him, the person who has done it. And the company which was making 750 crores profit literally became profitless. And this gentleman comes and turns around, and now it is 11,000 crores profit just in 4 years. They never had it so good. It is the most expensive, most valued, not expensive, most valued auto company. It is more valuable than Telco and Maruti. So when the turnaround happens, they go for the
Recording
kill.
in progress.
They just don't go back to where they started. They have become, I mean, they started from 600, came to 300. From 300, they didn't go to 600. They've gone to 3,000. And now the ambition is to go to probably 10,000. So I think when you buy these kind of companies, you also know about them. Change in the management team. ICICI Bank, it was about, how much? It is about 12,000 crores kind of profit, came down to as low as 4,000 crores profit, and now it has reached 44,000 crores of profit. Yes, Mr. Anish Shah is here. Welcome, sir. Please have a seat. I think just to refresh, Mr. Just last slide I showed about Mahindra & Mahindra, corporate restructuring, completely authored by you. In 2018, the profit of the company was 750 crores, and by the time you joined, I think in 2020 or something, it was literally flat, zero. And from there, it has become 11,000 crores last year. I don't know how much it will be, 16 crores or 15,000 crores current year. So this is something, actually to go down the history, what could be the size of turnaround one can underwrite. Okay, new product launches. Indian Hotels is another, very recent story of post-COVID, where they have launched the franchised, kind of properties, villas and hotels under the brand name of Taj, but managed by them, but not owned by them. So they are following very asset-light strategy. The ROE, which used to be 13–14%, now they will start shooting up to 20–25%. So it will be a very different kind of a hotel company as we go forward. Stock has moved from 70–80 rupees to now 800 rupees. And this is just about 3–4 years story. Cummins India, the most brilliant cost control-led healing of Cummins India. Of course, they are passing through low capex kind of a situation, but from 11% EBITDA to 19–20% kind of EBITDA, the stock shot up from, say, 100 rupees to more like 600 rupees and still counting. Debt reduction, same, Jindal and Suzlon and all, they are literally now debt-free, net cash companies. And the stock has done, Jindal Steel is up 14 times, and CG Power is up 17 times. So these are all very, very new, last 5 years story, post-COVID. So process of investing in blue chips. Now, so we have established the case for investing in blue chips. Enough we have talked about that. Now, what is the process of doing it? So create a watch list of Bruised blue chips. The moment the stock falls, first, establish the blue chip status in your mind. Second, create a watch list of Bruised blue chips. Like I want to track these companies. Say M&M I want to track, Indian Hotel I want to track, Telco I want to track. So whatever companies you are comfortable with. Third, await for the healing triggers. Just because they have just fallen sick, it doesn't mean that they have started recovering. So wait for those triggers to come. And market will give you enough opportunity. Market will always be skeptical that they have done the job. I remember in M&M, when they sold Sangyong, I never believed for the next 6 months or 1 year that actually they have sold it. I thought they would have subsidized it or something. The headache is still there somewhere. Because these foreigners, they don't allow you to get out. So, but Anish had done a good job. So, this skepticism is there in the market for a very long time because people have burned their hands. Buy only if the company's future prospects look good. So, just by statistical fall, you cannot buy. You have to understand, again as an investor, that prospects are great. Not only they survive, they will prosper. That call has to be yours. And then, I avoid talking about capital patterns, but there is the book at least recommends that use some technical, very basic level of technical analysis to figure out the point of maximum pessimism. I think Atul and all can help people in terms of finding the bottoms of fools and liars, but still you can take technical help to shorten the value trap or the waiting period for the recovery of the companies. The average price of Bruised blue chips, they come down. Look at the 7 studies and where do they come down? On an average, they come down below 2 book. So one of the conditions is that the price must fall to below 2 book. I mean, right now it's like a dream below 2 book, but yes, it does happen, and it will happen again in future. Yeah, so this is the current list of bruising. I think as of 28th November, these 11 companies, they have a correction of 30 to 80%. Adani Total Gas is down by 80% from their all-time high. Adani Green is down 64%, Enterprises down 42%, and Gujarat Gas down 39%. SBI Cards is down 39%. Avenue Supermart, DMart is down how much? 37%. Asian Paint and Berger Paints are down 32, 33%. So there are enough bruising is on even in this market for blue chips. Yeah. So now I'm to the last segment, market outlook. Here, if you look at the significant recovery from 2000 bottom, corporate profit GDP has moved up from 2.1% to 4.8%, which is very close to the last time peak of 2008, which was at about 5.2%. The market cap to GDP, the valuation of the market is at all-time high at about 140, 141%. So that is clearly reflecting the current euphoria in the market and elevated levels. The P multiple is still okay in the sense that average for last 10 years 23 and we are at about 24. So not that much alarming, but still at the higher end of the spectrum. The real story is that of retail participation. The demat accounts from 40 million in 2020 has crossed 182 million as of last month. The SIP numbers have crossed 25,000 per month. So what that has led to these three, I would say summarize the current market condition. FI flow, nobody can predict whether they'll be in or out, but very rarely they sell. Year before in 22 they sold about 17, 18 billion. In 23 they came with 22 billion plus. 24 they are flat, neither in or out, but total they have not sold anything. What it will be next year, we don't know. DI, $60 billion of flow and is still on. So I think if that 60 billion continues in 2025, so that is, I'm saying that is given, maybe 60 or 70 or 80 or 40, that depends what the size, but going by the current numbers, I think 50, 60 billion is given. Now corporate earnings, which is in our hands, that grew at about 21% between 20 and 24. That is kind of failed in the sense that in the first half, it has not grown, and our research department has downgraded the earnings for the current year, but most likely as second half capex, government capex picks up and it gathers momentum in the first half of next year, I think we are going to see a return of the earnings growth in 25, 26 to a level of 15 to 17%. But that's a iffy call. We don't know. If that happens, foreigners will also come. So if the earnings recover, I think you are going to have a party in the sense that the domestics are going to buy 50, 60 billion and foreigners are also going to buy 20, 30 billion. So I think the markets are going to, could be, there is a good chance it could be euphoric, but if by chance earnings don't come through, then maybe the markets will be current levels or it will consolidate here. It may not go anywhere. So the crux is corporate earnings growth. So market outlook, FI flows are unpredictable but strong. FI flows are unpredictable. DI flow is strong. Predictable retail-led DI flows will play a major role in the market behavior, and I think on a 2-year basis, the best is yet to come. Next year, maybe we may not be sure because of the corporate earnings and FI flow, but if you take a 2-year view, I think the best time is yet to come. We could see 30,000 crosses on a 2-year basis rather than 1-year basis. So to conclude, blue chips are aspirational investments, but mostly richly valued. So most of the people, they avoid that. Bruised blue chips are the ways to get into blue chips and buy for handsome returns. Probability of permanent loss of capital is close to zero in these bruised blue chips. The framework to invest in bruised blue chips is create a watch list, await for the buying triggers, and buy at attractive valuations. Wealth creation in last 5 years is the highest ever, but wealth destruction is zero. Please don't ignore this particular fact that there's no destruction of wealth, which is not a very healthy sign. PSUs are regaining prominence in wealth creation, so don't hate them the way we used to hate them earlier. For Indian equities, the best is yet to come. Thank you. Thank you very much.